Hey guys, what is going on? Welcome back to my Robinhood portfolio. Hope you guys had an awesome, relaxing weekend. What I thought I'd do today is talk a little bit about my investment strategy here on Robinhood. A lot of you guys have been asking why I've been picking the stocks that I have been picking for my portfolio, and a lot of you guys have opened up new Robinhood accounts and are wondering what a good initial investment would be. So I kind of want to talk through how I've picked stocks for my portfolio, and then how I have been adding money to my portfolio. So let's go ahead and pick out Ford here. This is a company that kind of is the quintessential stock that I've been looking for purchasing. So Ford here, it's a large market capitalization company. That's the first criteria. It has to be a company that has greater than $5 billion in total net value. And essentially means it's a very large company that has very low risk of folding. Yes, a lot of large companies do fold, but for the most part, if they're a large company, it's a little bit less risky than buying into small cap companies that are still trying to find their way in their particular market sector, may not be established like a Ford would be in their particular market sector. That kind of goes into the next criteria. They need to be blue chip companies. That is, companies that are household names, stalwarts of their particular market industry, leaders in their market industry. So Ford, for example, would be a leader in its industry in the automotive sector, which is contained within the consumer discretionary kind of market sector overall. So it's a large market cap, it's a name brand blue chip stock, and then it has to have a good dividend yield. And you can see here in the middle, Ford does have that 4.9%. So I'm not trying to find stocks that have 12% like a lot of the closed end companies do. I have a couple of those. I kind of just bought these for fun. I'm not going to put a lot of money into these. Like PSEC here, for example, it's got a dividend of where is its dividend? 12.6%. So that's a very nice dividend, but over the long haul, it's going to be very hard for this particular company to maintain that. It's going to be a big burden on the company. So for a long-term play, I would not suggest getting into something like that. So having said that, most of the companies that I have are all large cap, high dividend yielding companies that are blue chip stocks, household name brand stocks. And then after I pick out companies, then I try to get a balanced portfolio. So I basically put a few stocks in healthcare, for example, up top here, Pfizer, AbbVie, Abbott Laboratories, Cardinal Health, Johnson and Johnson. And then I essentially pick, five or so stocks in each market sector. So five in healthcare, industrials, consumer discretionary, consumer staples, financials. I go down the bottom here, information technology, telecoms. And then I also put in some utilities, real estate investment trusts, closed-end funds like I talked about with PSEC. And then I also have a few stocks on the bottom here, just kind of for fun, a bond fund and some penny stocks. So then after I essentially select my stocks, the large market capitalization, blue chip, high dividend yielding stocks, I put a few in each market sector, and then I start dollar cost averaging those stocks. So dollar cost averaging is a way of putting in a set amount of money. Let's do Abbott Laboratories here, for example. So you basically put in a set amount of money, and this is kind of where it went from Abbott Laboratories into Abbott Laboratories plus AbbVie. That's what accounts for that big drop here. Let's do another stock, actually. Let's do Pfizer here, for example. This is a good stock that I made a mistake on that dollar cost averaging would work perfectly for. So dollar cost averaging is a way of putting in, for example, set amount of money each month. So you put in 100 here, 100 here, 100 here, and then so on and so forth. 100, 100, 100, 100. Each time the price of the stock went up, you would be basically buying less shares of that stock. If each share here was $20 and you bought $100 worth, you buy 5. But if the stock went up to $50 per share and you put in 100, you buy 2. And conversely, if it goes down, you buy more shares of the stock. So if it's $50 here, you put in 100 in, you buy 2. If it goes back to 20, you buy 5. So that's a way of essentially averaging out the cost of the stock over the long term. The whole idea, and the mistake I made is, for example, I went ahead and I bought a large chunk of stocks right here. It went up to actually $37 here at one point. I put in, 100% of my buy there, and then it went down. I'm losing a lot of money on this particular play. And you can kind of see that on the bottom here. My total return is negative 277. What I should have done, instead of buying all my shares here, I should have bought, 10, 10, 10, 10, 10. And that negative 277 may be only negative 75. it works the opposite way as well. If I would have bought all my shares here and it went up to 37, would have made a lot of money. But again, if it went down like it did, I'd lose a lot of money. So again, the safe way of doing this is putting in 100 here, 100 here, 100 here, knowing you're going to be making less when it goes up, but if it does trend down, you're going to be losing less as well. So that's what I've been doing essentially, is picking companies with those 3 criteria that I mentioned and then putting in a set amount of money every month. And then I've went one step further, and I've been picking industry sectors that I think have been undervalued to put in that money. So I might put in $100 a month, but I wouldn't necessarily divide that up over all market sectors. If I thought healthcare was down, which I do right now, I've been putting essentially that money into healthcare stocks. So not only have I been dollar cost averaging every stock, but I've also been dollar cost averaging the market industry as well. I hope that makes sense. It's a little bit more complicated than a 5-minute video can describe, but essentially I've been putting in a set amount of money and then selecting stocks that may be a little bit more down than up, if that makes sense. So if Abbott Laboratories here, for example, is falling, which it has been over the last 3 months, then I've been putting a little bit more money in than I would up here. Then conversely, a stock like Lockheed Martin here that has actually went up a bit, from 250 to 260, then I'll be putting less money in this stock. But overall, I'll be putting in the same amount of money, if that makes sense. So I put in $100. The stock that's down, I might put in 75, and the stock that's up, I might put in 25. And conversely, if they change, then I'd switch it up and put the $75 in the stock that's fallen and the $25 in the stock that's going up. So it's the same amount of money per month, but I've been choosing on market sectors that may have been a little bit more depressed versus its other, market sector, if that makes sense. A little bit more complicated than that, but essentially 3 criteria I'd use to choose stocks, dividing those up, diversifying over a large number of market sectors, and then putting money into market sectors that may be a little bit more depressed relative than a very, very good market sectors. Like right now, financials are very good, industrials are very good. So I'm putting a little bit less money into both of those, and I've been putting more money into healthcare. I think it's a little bit depressed right now. I think it's going to rebound early next year. So yeah, that's kind of what I've been doing with my portfolio. I know I went through a lot of information pretty quickly there. It gets a little bit more complicated when I talk about how I'm dividing up and putting money into my portfolio. But I think the key thing to take away from this is, at least from my perspective, you should be buying stocks that are, solid stocks that you can hold essentially indefinitely. So a lot of these stocks that I've bought, if I were to close my portfolio and not open it for 5 years, I think I would be very satisfied that when I opened up my portfolio again, these stocks would be looking very, very good and I would have made a lot of money. So yeah, that's kind of what I've been doing with my portfolio. I hope that's made sense. I know I went through that fairly quickly. If you guys have any questions about that, let me know. But yeah, I'll kind of end the video on that point. As always, if you enjoy my videos, feel free to like, share, and subscribe. As you guys know, I love learning about investing, so any pointers that you have, let me know. If you don't necessarily agree with the way I'm doing this, let me know why. Maybe there's a better strategy of doing this. I know it gets a little bit more sophisticated. There's value cost averaging versus dollar cost averaging. I think I'm doing a little bit of a hybrid dollar cost averaging anyway. But yeah, let me know what you guys are doing, and always let me know if you guys have any good plays that are coming up, any stocks that you've been investing in, have been making a lot of money. Now that my stock portfolio is over $25,000, I'm going to do a little bit more day trading. So if you guys have any good stocks for me, let me know. And kind of with that, I'll end the video, and I'll see you guys tomorrow.